What is going on, everybody? Sean Doan here, and in this video I want to go over my complete stock portfolio. I want to walk you through exactly what stocks I'm investing in, what I'm buying, and where I'm buying from, which websites I'm using, which apps that I'm using, and also why I'm doing what I'm doing. So if you're new to the channel, I cover a lot about self-publishing and making money online. However, I am passionate about personal finance as well, and once in a while I cover those topics as well, like in this video, and I want to start covering more. So what I'm probably gonna do is do like a update video every month or every couple weeks on the progress of my stock portfolio. Today, at this point, I have total of $30,000 invested in the stock market, and hopefully my goal is to get to $100,000 very soon and keep building it to to the point where I reach $900,000 invested. Because if you follow the FIRE movement, which stands for Financial Independence, Retire Early, they talk a lot about your FIRE number, right? Which is the amount of money that you need to be invested in the stock market to retire from stocks only. And the way it works is if you buy and hold index funds, which I'm going to explain what it is later in this video, you generally see a growth of around 7 to 8% a year with index funds. So historically, index funds always grow 7 to 8% average a year. So the idea with the FIRE movement, or the FIRE number, is for me, if I wanted to live under, I think it was $30,000 a year. So no, $36,000 a year, I think. So that comes out to about $3,000 a month, right? So if I can get $3,000 a month in passive income, then I can, I'm very frugal and whatnot, so I'll happily be able to live off that money. So you want to calculate that number, and I'm not gonna go into how to calculate it and whatnot in this video because it's gonna be a whole nother topic. But basically, the calculation comes out to $900,000 that needs to be invested in stock, in the stock market, with the basis of the stocks growing 7 to 8% a year. And the idea is that, to quickly explain you how it works, is if I have $900,000 invested, even if I take out 4% every single year, and the 4% of $900,000 should come out to $36,000. Let me do a quick calculation here to just make sure that I'm not giving you some BS numbers here, because I made the calculation a while back. But $900,000 times 0.04. Yeah, so 4% of 900 grand is $36,000. So the idea is I can comfortably take out 4% from the 900 grand and make $36,000 a year from the stock market. But the stock market is growing 7%, right? So I'm taking out 4%, but the stock market grows on average 7%. So that means even if I take out $36,000 a year, I'm not losing the principal, which is 900 grand. That's not going to go down because it's growing an additional 3% every year. So once you hit the FIRE number where you can take out money like that, but the money in the stock market does not decrease because it keeps growing on its own, then you're financially retired, in the sense of stock market investing, or FIRE, right? So that's the goal, is 900 grand. But right now, the first goal is 100,000. And I will kind of, walk you through where I'm investing. So kind of a long introduction there. But if you like these kind of videos, make sure to subscribe, like the video if you enjoy it. And I do have a free guide on how to make money from self-publishing. The link is in the description below. I'll walk you through the entire process of self-publishing and how I make money online. I have a ton of videos on that as well. And I do have a free Facebook group that you can mastermind with people. We can also talk about personal finance, so definitely join that. The link is in the description again. So in this video, what I'm going to do is I'm going to show you all the places that I'm invested in. I do not recommend you invest in multiple locations like this. I did this just because I had no idea where I would start investing, so I just started watching some videos. Some people recommended Acorns, so that's where I started. And then I learned that I need to do a Roth IRA, so I went to Vanguard, and then I went to E-Trade, and then I tried out Robinhood, and then I found out about M1 Finance, which is my favorite platform. M1 Finance is by far the best one, not just from my opinion, but pretty much every, if you look at like other finance channels, they also recommend M1 Finance as well. So that's what I would recommend for you to get started. I'll show you how to get started. And again, you don't want to put your money in so many different places because it's going to be hard to track. You want to keep it simple, and keeping it simple means just investing in one location or one site if that's possible. So anyways, I'm going to show you in order what I started with. So I started with Acorns, and Acorns is great because it's automatic investing. You cannot choose which stock to buy. You can only select the type of portfolio that you want to invest in. So Acorns has a set of portfolio depending on how aggressive you want to be, and they invest it for you, which is good because it's automated, and it's a portfolio is pretty diversified. The returns are good, and there's also the feature of you can link your credit card to Acorns, where every time you use your credit card, they'll invest the spare change for you. The downside of Acorns, so do I recommend Acorns right now? And the answer is no, because Acorns is the only app or the only site that charges you a fee to invest. So you have to pay $1 a month, which is not a lot. $1 a month is not a lot. However, if you're only investing like $100 or $200, whatever it is, and you're paying $1 a month in fees, that's an insanely high fee compared to how much you're investing. Okay, so if you're investing like $5,000 or $10,000 or $20,000, paying $1 for the management fee or whatever is completely fine. But if you're just getting started, that's a lot. And all the other sites, there's literally no fees whatsoever. So, why would you even want to pay $1, right? So Acorns, who is it for? It's for people who are like completely new, who don't even want to think about logging into the app. So basically, you don't even want to log in and just click a button to invest your money. You don't even want to do that. So you want everything 100% automated. So you just link your credit card and forget about it. So every time you spend your card, you invest. That's great, but I mean, preferably you take a little more initiative so that you can even set up automatic investing on other apps too. So there's really no point in Acorns, I think. And I also don't like how you cannot select which stocks you want to buy as well. So I do not recommend Acorns, but this is what I have right now. Once the market goes up, I'm probably going to sell it. I'll sell what I have and move it into M1 Finance. I just don't want to sell it because I'm going to get taxed, right? So that's why I have the money sitting here. So that's total $5,644 right now. The next one is my Vanguard account. So Vanguard is one of the first companies that started low cost investing, I guess, and index funds investing. It is one of the older one. So now there's a lot of new startups that are disrupting the stock market investing, I guess, the field. So like Acorns, Robinhood, M1 Finance, they're all doing no fees trading, right? So Vanguard isn't the first one anymore. And the issue with Vanguard, the website is very tricky. They don't even have a mobile. They do have a mobile app, but it's like impossible to use. And I have a Roth IRA with Vanguard, which is okay. But I personally would like M1 Finance Roth IRA right now. So if I would start over, I would just create a Roth IRA with M1 Finance. Again, I might move my Roth IRA to M1 Finance as well, but this is what I have. So I have $13,000 invested. The returns is $265 negative because I literally put in $6,000 right before the crash that happened. So that is that. But that's another $12,000. So with Vanguard, what am I buying? Literally 100% in VT-SAX. So VT-SAX is an index fund that pretty much covers the entire US stock market. So again, index funds is just a collection of stocks compiled together, right? So instead of buying one stock and betting your entire money on it, like say, I want to buy Facebook and putting 100% on Facebook. Well, if Facebook crashes, then you lose all of your money. However, with index funds, especially with VT-SAX, is one of the most diversified index funds out there. You're literally, when you buy one fund of VT-SAX, you're buying three 3,680 companies within that fund. So what happens if one of the companies, go bankrupt, right? You still have 3,679 companies that are running, so you don't really get affected. At the same time, there's the opposite of that, right? If one company does extremely well, and grows a lot, you don't really get affected, so you don't really make a lot of money from that. But the whole point is, it's very, very safe, it's very, very diversified, and it's very secure. And then again, the index funds on average grows about 7%. So this is one of the most passive investments you can ever make. So 100% of my money is in VT Sachs. There's literally a investment strategy of buying just VT Sachs, and that's it. People just buy VT Sachs, nothing else, and forget about it. So, stock market investing is actually a lot simpler than you think once you understand it. So the next one is E-Trade. So I'm not going to go over, why I have, I'm going to explain it real quick. I have my solo Roth 401k with E-Trade. So it's kind of like a 401k, but I get taxed initially when I invest the money. I'm putting my post-tax money to this instead of my pre-tax money like a normal 401k. I'm not going to go and explain it in detail because it's too complicated right now, but that is what I do. Also buying VTI and VOO. So VTI is literally just a ETF version of VT Sachs, okay? And so VT Sachs is the index funds, VTI is the ETF. The difference is nothing. You don't even have to understand the difference between an index fund and an ETF because it's not even worth your time to understand the difference. It's literally the same thing. It literally covers the same companies and whatnot. So VTI, just remember, it's VT Sachs, same thing. And that's what I started. And VOO is very similar, but instead of covering like 3,600 companies, there's only 500 companies in VOO. So it's still very diversified, but it's a little more aggressive, right? 500 companies. So, there's more volatility and I wanted to take a little more risk. So that is why I invested in VOO. But basically there's two funds, again, keeping it very simple. So that's 13,000. Actually, around 5,700 invested because the other is cash. Okay, so with Robinhood, I have $1,000. This is just play money. I had no intent in buying and holding index funds, so I bought this is after the crash that happened. So I bought some Delta, I bought some Norwegian Cruise Lines, Royal Caribbean, and I have a Carnival Cruise Lines as well. And so these are the stocks that I bought, and because the market came back, I have some gains, but this is just play money. I don't recommend you to buy individual stocks like that unless you're willing to lose it. And again, I was willing to lose it. I just wanted to play with my $1,000, so that's what I have. All right, so the last one here is my favorite, M1 Finance. So M1 Finance, again, the website is amazing, the app is amazing, and it's just a better option. So for a Roth IRA and also for a taxable brokerage account, I would recommend M1 Finance. So that pretty much means, for everyday people, you should just use M1 Finance and you're good to go. But what I invest in this is basically I'll show you what I do. So 90% is just index funds, again. Literally just 3 funds. So I call it the 3-fund portfolio. It's a very famous investing strategy, which I'm going to explain a little bit later on. But basically the idea is you're buying just 3 index funds. And this 3 index funds will cover the entire stock market in the whole world. So you're buying basically, again, VTI, just like E-Trade, right? VTI is just VT Sachs, so it's an ETF version of VT Sachs. You're buying over 3,600 companies in the US. So just by buying VTI, you're invested in the entire pretty much US stock market. So you're buying the stock market of US or US economy. So I have like 85% of that. And then I have a little bit of Vanguard Total International Stock Market, so VXUS. This is same as VTI, but for international companies, okay? So I do that for 9.9%, almost 10%. I don't know why I have 0.1% off. Should be 85% and 10%. But don't even get hung up over the percentage. But basically, yeah, so 85%, 10% international. And normally for a 3-fund portfolio, you want to put bonds for the third one. So you should be buying bond index funds to counteract, because stocks are a little more volatile. If the market goes down, the stock market goes down. Bond usually comes up. However, because I'm young, and bonds really doesn't grow your money. Bonds really just kind of hold the value there. I wanted to take more risk and have something that actually grows my money. That is why I invested in VNQ, which is a real estate index funds. So it's REIT index funds. So now I'm covering a little bit of real estate market as well. So the returns are very good, 27, 24. I mean, definitely not typical, because typically it's only 7% a year. But, for this, I bought it at a very good timing after the market crashed. I was buying some money, investing some money here. So that is why the growth is very good, because the market definitely came back, right? So that is, I believe, 90% or 95%. 90% of my entire portfolio. The other 10%, no, I don't recommend this unless you're willing to lose money again. I bought individual stocks. However, I'm not buying, I'm not cherry picking these very volatile stocks. I'm just buying companies that I personally use. I know that it's going to stay here for a very, very long time. And I'm doing a lot of research on these. But obviously, everybody knows Facebook, Google, probably not going to go anywhere. Uber, kind of iffy, because of what's happening recently, but I believe Uber will stay a little longer, and that's why I only have 5%. Tesla, I changed it to 1%. I used to buy more because of the price just jumped too crazy. It's too expensive right now, so I only have 1%. And then Apple and Amazon, I didn't put as much as Facebook and Google, because even with the crash, it was kind of expensive, so I didn't put much, but I just put a little bit in there. So that's what I do. But again, to keep everything simple, I'm putting a lot of time in just keeping up with the market and the news, and should I sell it, and changing these portfolio values. So if you want to just skip that, just do the 3-fund portfolio, and that's all you need. So combining all of this, it comes out to around $30,000 that I have invested in the stock market. And real quick, I just want to show you how cool stocks are because of the compound interest. If you say, I have $30,000 right now, right? So you can go to this website and test it out as well. But say you have $30,000 and I don't even put any money anymore. So no additional. And then, say I'm 25 right now and I'm not going to use the money until I want to retire at like 50, I would say. So that's another 25 years. And on average, most of my money is in index funds, so I can confidently say that on average, my stocks will grow at a rate of 7% or something per year. So I'm not putting any more money, just having the 30K sit there for the next 25 years and say it grows 7%. The compound interest, this 7% applies once a year. And let's calculate. So after 25 years, this is going to be 162,000. So just from doing nothing, just holding it, sitting there in the stock market, it's going to be 162. Obviously, I'm going to be putting more. Say I would do 10,000 every single year, right? Then it'll be 839,000. So it is nuts how, crazy the compound interest is. And that is why I love stocks so much. All right, so this is one of my first stock market in-depth video. So it is getting kind of long because I'm trying to explain everything, and in the future I'll make it more concise. But the last thing I want to cover is if you're watching this and you're interested in getting started, and obviously you must be confused because it took me months of watching YouTube videos to really understand how it works, right? So if you're asking how to start investing in stocks, this is what I would recommend. First of all, you got to understand the order of investing, right? Because I showed you many different accounts. The order of investing is if you have a job and if your employer offers a employer contribution, right? A lot of times it's 4%. If you put in whatever, income, they match 4% of that. If your employer offers that, you definitely have to get started immediately and do that, because that is literally free money your employer is giving you in your 401k. So even though you cannot take out your money until you retire with the 401k and also the Roth IRA, because both are retirement accounts, and a lot of times when entrepreneurs see this, and I felt the same way initially, where like, man, age 60 is such a long way ahead. I'm sure by age 60, because I'm building my business, I'm going to be a multi-millionaire. I don't even need a retirement account because I'm going to be balling and everything. Well, guys, I felt the same way, but then, you got to be realistic. I'm not trying to crush your dreams or anything, but realistically, not all of us going to be multimillionaires from our business. Maybe you want to stop working, you want to stop grinding until you're 60. You're going to get tired of that. Maybe you just want to live a, free life. And why would you want to work so hard to make up for the free money that you're going to make from years of compound interest, as I just showed you, right? And then you don't even have to pay taxes on it because it's 401k and a Roth IRA, so it's tax deferred. You're not even paying taxes. So it is so much money that you can make from doing nothing. And realistically, not all of us are going to be multimillionaires. So again, you got to kind of let go of your ego. A lot of times people overestimate what you can do in the long term. So yeah, just invest in your 401k. And then if you don't have a job, or if your employer does not offer a employer match, then obviously the priority will be a Roth IRA. Okay, so with a Roth IRA, you can use M1 Finance. Again, the link will be in the description for M1 Finance. With a Roth IRA, there's a contribution limit. So you can only put $6,000 a year for Roth IRA. With a 401k, which is the next. So once you're done with contributing $6,000 a year, and say you still have more money that you want to invest in the stock market, then you're going to go back to your 401k. With a 401k, you can put $19,000 a year at the moment. So if the employer offers an employer match, you do that, however, till the employer match, and then you go to your Roth IRA, and then once you're done, you go back to your 401k and finish up the 90k. Now, if you are self-employed like me, then you can open up a solo 401k. That is exactly why I went to E-Trade, because they offer a solo 401k. So that's what I did. Finally, you can invest. If you have more money than the 6k and the 90k, then you can go to your M1 Finance, because they also offer a taxable brokerage account. So this is basically just a normal account where, when you take out the money, you just have to pay tax, compared to with a 401k or Roth, when you take out the money, you're not paying tax. So it is just a normal account that you can trade stocks in. So that is M1 Finance. You put rest of the money that you have, however much you want to invest in. So again, the next question is, what should you invest in? The most passive and simplest way of investing is buying and holding index funds. Again, very low risk. Of course, you never can guarantee if you're going to lose money or make money. Nothing is guaranteed in life. However, historically, over like 100 years in the past, it always grew 7%. Even during the crash. During the crash, it'll come down, but then after the crash, it'll go up. And on average, it always grew about 7%. So that is why you can confidently say that it'll grow 7% a year. And index funds, again, it's a collection of stocks, right, that covers the entire market. So the 3-fund portfolio literally covers the entire U.S. stocks, international stocks, and you can do bond market. If you want to know how to, do the 3-fund portfolio, all you got to do is Google. So all you have to do is Google 3-fund portfolio and just read one of these articles, and they'll literally tell you which stocks you have to buy. It's usually like VTI, and then again, the international one and the bond market. Alright, so finally the question is, when should you start investing? What you want to do is, you do not want to wait for the dip, or you don't want to wait for the next market crash, because again, everybody predicted another market crash, and now the market keeps coming up, right? So no one can predict when the market goes up or down. So what you want to do is to invest steadily every week or every month. This is called dollar cost averaging, and what that basically means is you're just buying every single month at a set date, like maybe the first of the month, or you're buying every single week on Monday, right? No matter if the price is higher or lower, doesn't matter, you're just buying it. And what this is, it averages out the price of the stock that you're buying. So sometimes it's going to be higher than what it should be. Sometimes the stock price will be lower, but you're always getting the average, because you're just investing every single week or every single month. So it's, you know, you're not going to get the best price maybe, but you're getting the average price. So that is pretty much the most steady way of doing it. All right, so that was a very long video, but hopefully everything made sense. It probably didn't. You probably have to rewatch it a couple times and keep learning, you know, about stocks. That's how it was with me. But over time, you will learn. Stock market is very, very passive. Again, you don't have to do all the work like real estate. You know, you can just invest and pretty much forget about it, especially with index funds. So that is why I love stocks. And again, if you want to get started, I'll leave a link to M1 Finance in the description. And also, if you want to trade stocks, so M1 Finance is very good for like passive investing, so just like index funds as I explained in this video. But if you want some side cash, or if you want to like do day trading or just, you know, investing in more of an individual stocks like I showed in my Robinhood account, or if you just want 2 free stocks, you can go to Webull. So they are offering 2 free stocks. Basically, if you open a Webull account, they will give you a free stock value between $2.50 to $250. And if you make your initial deposit of $100 or more, so if you put $100 or more initially, then you'll get a second free stock that could be valued up to $1,400. So when I opened my Webull account, I got I forgot the name of the stock, but I got a stock that was worth $50 or so. So it is worth it. Definitely go ahead and do that. The link is in the description as well. Alright guys, thanks for watching, and if you enjoyed the video, please leave a like, consider subscribing to the channel, and leave a comment on if you have any questions, any video ideas on what you want me to make, and I'll see you guys on the next one.